So thank you for taking the time to come and listen to me. I was asked by the organizers to reflect on maintaining growth in a low oil price environment, which you might think is counterintuitive, because in a low price environment, we should stop growing and we should save capital. So let me talk a little bit about what we at New Age are doing in this environment. So two key challenges that we see in our business today, which is how to maintain good economic returns at $50 a barrel and how to get access to capital. And they're both directly related, perhaps why the answer to that question you raised earlier on, until you actually put the expected returns into the pot, it's hard to decide what the answer is as to whether the risk is worth taking. So in terms of the economic returns at $50 a barrel, we see that shallow water, onshore easy access, areas where the infrastructure is already paid for or amortized, flat gas sales agreements, and large fields are clearly still attractive at $50 a barrel. The challenge starts with ultra-deep water, with the Arctic, with renewables, and with small fields. I think that's pretty obvious and intuitive. Obviously, there is a play around political risk. Generally, where the political risks are perceived to be higher, the economics are normally better, and we tend to find that capital costs are lower on onshore, shallow water, political risky places. And then there's access to capital, which is the other side to the equation. And certainly the capital markets are very tight today. I don't need to tell any of you that they're very tight, especially for public companies. And we're beginning to see that the markets had a bad run, or investors have had a bad run for the last 10 years. And as oil prices have floated up, most of our industry has taken the cost curve up with it, so margins have stayed pretty constant. So now we see oil prices come down, the margins get squeezed and are probably negative. We're also starting to see that the debt wants to be linked to assets now. So whereas in the past debt could be at the topco, now many debt providers are asking for security on the reserves, and we're beginning to see a bigger and bigger play by private equity. Now, we've been in the private world for the last 7 years, so we're much more familiar with what private equity looks like. So what is New Age and what do we do? So we're a private company. We're focused on sub-Saharan Africa. I personally have worked all the other regimes. I've worked Southeast Asia and Asia. I've worked Australia, North America, South America, and Russia. So you could argue the only place I didn't know was Africa, but actually I did know a little bit about that and took the view that most of the big underexplored basins are in Africa. So we're now in 7 countries. We have 19 oil and gas blocks. We have 6 oil fields and 6 gas fields. We have just under 1 billion barrels of reserves, and we're in the process of developing most of those hydrocarbons. That's a picture of our operations. The green represents the countries in which we operate, and the blue represents the basins in which we explore in. So we're exploring mainly turbidite fan sands in the shallow water shelf edge and onshore rift basins. That's our expertise. And we're in Iraqi Kurdistan, North and South Ethiopia, South and West South Africa, offshore shallow water Congo, Brazzaville, similarly Cameroon and similarly Nigeria, and we've just entered into Morocco. So we actually can do the round robin in Africa. In terms of giving you a sense of the history, we're just 7 years old, and this is the activity timeline that we've been involved in. So we made 2 discoveries in 2013. We then had a fantastic subsequent year and continued to make 4 discoveries in the following year. And then our first development contract in 2014 in West Africa, our first platform installed the same year, another discovery in Iraqi Kurdistan in the same year, and then our last discovery of 2014 in Congo, Brazzaville, and then we entered 2015 with another first oil production from an earlier discovery, another first gas to onshore Congo, Brazzaville deliveries, our last discovery currently being tested, and then we're just about to finish off our Ajay development, and we're about to go to FID on our final and last discovery. So that's a pretty busy piece of history. And of course, during this time, we had 2 oil price crashes, one in the global financial crisis, when we were just raising our first capital, and then one more recently when we were at the peak of our capital investment. So we get to feel all the pressure related to a low oil price, and yet we're still very actively growing. So in summary, we have discovered 6 oil and gas fields in the last 7 years. 5 of them have been to FID or in development, so we're at our maximum part of capital investment. 2 fields have already come on stream, and we'll get 3 first oil and gases over the next 12 months. We have a pretty heavy investment schedule. We'll invest another $1 billion between now and 2018, and then we go into free cash and generate circa $500 million a year thereafterwards. Our production forecast, production profile looks like the deep blue is from our existing discovered hydrocarbons, and the light blue is from future possibilities. We're about 75% reserves in West Africa, and the remainder in East Africa and Kurdistan, and then we're about 25% resourcing, about 5 billion barrels of drillable resources, of which a quarter is in West Africa, and the rest is spread over the remainder of Africa. Our Congo-Brazzaville operation is our largest. That platform, you can see on the top right-hand side, was installed mid this year, and we're now producing gas to shore to supply a local power plant and stripping out oil and condensate. And then we're going to install our 2nd, 3rd, and 4th platform, as the diagram shows, over the next 24 months. And then we'll go into an LNG project that'll follow on. So we've got 5 trillion cubic feet of gas and just over 1.5 billion barrels of oil. And we'll produce somewhere around 150,000 barrels a day at peak and around half a BCF a day. We also reached development approval for our operation in Nigeria just after Chevron exited, and we've now drilled our development wells. We completed them last week, installing the trees, as you can see from the picture, and the FPSO set sail from Singapore, where it's been refurbished in the 2nd week of December this year. So we'll start producing oil in Nigeria in February next year. We'll start at 10,000 barrels a day, and we'll ramp up to 20,000 barrels a day soon thereafter. And then we're currently development drilling in Iraqi Kurdistan. We're on well number 2, and we're going to drill a total of 5 wells. We made the discovery mid last year. We declared it commercial 2 months after discovery and got government approval 6 months later. We've been producing oil into the domestic market, so we're not an exporter. And we got $47 a barrel for our last cargo sold, so we're actually not getting a significant discount to Brent right now. And we're just going to ramp up production to about 10,000 barrels a day by end of next year. This is our activity, so we're very busy for the next 3 years. I won't go through all the details, but every one of our operations has major development, production, and commercialization milestones over the next 2 years. So we then ask ourselves a question: how do we do all this in this low oil price environment? And I think the dotted line helps you to understand. So our average full cycle development cost is $17 a barrel. That is assuming a 10% return on capital. So that's right the way through from the first exploration dollar to the last development dollar. We're around about $17 a barrel. And I put on the same chart shale oil, ultra deep water, and many of the other projects, and you can see why the oil industry is in as much distress as it currently is. And then on to, what does the sort of future look like? But before I get on to what the future looks like, how do we manage to get ourselves into a development environment where our full cycle development costs are only $17 a barrel? And the main tactic we've used is going in very early. So getting into countries really before government has ramped up economic returns, get in before a big play has been discovered, or get into the early part of the play, have a low cost of entry, and then concentrate on shallow water and easy access onshore. The flip side of the same coin is these will also, therefore, by definition, be higher risk. They'll be higher risk because the technical merits are not proven, or they'll be higher risk because the political areas are more circumspect. And in that respect, first of all, we've got a big portfolio, so we manage our risks by diversification. No one country runs into the same turmoil at the same time, so we can spread our activity, spread our investment. Second technique we've been using is spending a lot of time with the politics of a country, understanding what drives the politics, what drives the risk. And many of you who know Nigeria will know plenty of operations are continuing uninterrupted in Nigeria, whereas the majors are exiting because of perceived risk. So often risk is a perception perspective. It takes 3 or 4 years for people to fully understand the risk, so there's always a perception gap, and if we get the timing right, I think the example on Egypt is a perfect case study. If If you ask most people whether they want to invest in Egypt 18 months ago, they probably said not right now. And by the time Egypt gets itself sorted out, it'll be too expensive to make the kind of returns we need. Of course, the corollary of going into places early where there's risk is the need to find investors who understand that perspective. So we built a private company with a group of private investors, and we focused on private investors who are long money, who understand the emerging markets, who understand how political risk works, but also have voracious appetites for returns. So we have to keep the returns very high in order to attract that sort of capital. We've been working with private equity since we formed the company in 2008, and I think many other companies in this space looking for capital are going to have to get used to dealing with private equity, and they certainly require much, much higher returns than the public market does, and they require much, much more control over the operations and activities, and that takes a long time to build the trust associated with it. So on that note, I'll leave you with a little proverb, which we can all think about as we continue to see low oil prices for the next 6 months. And I'll hand back over to our compere. Thank you very much.